Good day, everyone, and welcome to today's discussion on investment in associate. Before we start, make sure that you have your calculators with you as well as a pen and paper since we will be answering one problem after the discussion. For the contents of this video, first I will be introducing the theme, then we will move on to the discussion on investment in associate and relevant standards, then the problem and the questions, and lastly, we will be trying to solve it all together. Meet the MAEstros. We have Ana Marie Arbutante, Mary Carmel Bukat, Abdul Malik Bulig Mangutara II, and Earl Stacy Gale Padilla.
Today, hello everyone. Today we'll be learning about investment in associate and we hope that you'll learn something from us at the end of this video. Before we solve your problem, let us first discuss what investment in associate is and its basic principles. PAS 28 prescribes accounting for investment in associates and the application of the equity method to investments in associates. Now, let's define intercorporate share investment. Intercorporate share investment is the purchase of the equity shares of one entity by another. In other words, it is a case of one entity investing to another entity through the acquisition of share capital. In such, an entity may purchase enough shares of another entity in order to exert significant influence over the financial and operating policies of the investing entity. So what is an associate? According to PAS 28 paragraph 3, an associate is an entity over which the investor has significant influence. Speaking of significant influence, what is significant influence and when does significant influence exist? Significant influence is the power to participate in the financial and operating policy decisions of the investee, but it's not control or joint control of those policies. It is presumed to exist if the investor holds directly or indirectly 20 to 50% of the voting power of the investee. Conversely, significant influence is presumed not to exist if the voting power is less than 20%. But an investor may have significant influence even if it has less than 20%, which will be discussed further by Mary.
Other evidences of significant influence. So there are times where the company has less than 20% ownership but still has a significant influence over the other. These situations are as follows. A. There is a representation on the board of directors or equivalent governing body of the investee. B. There is participation in policy-making processes, including participation in decisions about dividends or other distributions. C. There are material transactions between the entity and its investee. D. There is an interchange of managerial personnel. And lastly, E. There is provision of essential technical information.
Hi, this is Stacy. So the other concept that I would introduce to you would be cost method versus equity method. I would be giving additional information as well as advantages and disadvantages for more understanding. So don't forget to take notes. Without further ado, let us start off with cost method. This method is used when the investor exerts little or no influence over the investment that it owns, which means, as it is said in the bullet, it is used when the investor company holds less than 20% ownership over the investee. Going over, when dividend income is received, it is recognized as income on the income statements. Since the investor does not share in the profit or loss of the investee because of their independent legal relationship. To talk about its advantage, the cost method is easy to use and does not require complex calculations or assumptions. Weighing out with its disadvantage, cost method does not account for equity income, which can be a weakness for investors who want to track their investments performance. So next would be equity method. Here we can see it is used when an investor has significant influence but less than 50% ownership, which means it is not enough control to be considered a parent company. When we say 50% ownership, meaning it goes around 20 and 50%. It is important to be aware that some companies with less than 20% interest in another company may also hold significant influence, in which case they also need to use the equity method. Relatively owning 20% or more of the shares in a company doesn't automatically mean the investor exerts significant influence, because there are processes to be considered to have an impact on the value of the investee company, telling us that it is important to evaluate the appropriate method to use. For a better grip, here is an example. Investor A has a 19.5 ownership interest in the voting common stock of investee B. Investor holds one of 5 seats on investee's board of directors. So, what can we say in this situation? Investor is likely to conclude that the combination of its voting common stock ownership and its representation on the board of directors provides it with ability to exercise significant influence over the operating and financial policies of investee. Therefore, equity method should be used. So for the next bullet, dividends received from the invested company are recorded as a reduction account. Since dividends are treated as a return on investment in this method, therefore they reduce the value of the investor shares. By using equity method, it reflects actual financial position of the investor. This is because the equity method requires a company to account for its investment in another company based on its share of investee's net asset. For example, Company Alpha has a 30% ownership in Company Beta. If Company Beta makes a profit, Company Alpha's share of that profit will be reflected in its financial statements. This ensures that investors' financial position is accurately reflected in its financial statements. Balancing out with its disadvantages, it requires significant effort and resources. So, it really means that it is costly good. This is because equity method requires a company to account for its investment in another company based on its share of the investee's net assets, which could be time-consuming and complex. To conclude, the two methods, equity and cost method, an investor uses the equity method to recognize its portion of the income and losses of an investee, while under the cost of method, none is recognized. How much control the investor has over the investee determines which approach to use. So next would be the accounting procedures. But before we discuss the said step, it is important to know that this is for us to be guided when we are to use the equity method. First step would be letter A. Investment is initially recognized at cost. It is adjusted thereafter for the post-acquisition change and the investor's share of the investee's net assets. Next would be the carrying amount is increased by the investor's share of the profit of the investee and decreased by the investor's share of the loss of the investee. In other words, investment income is the portion of the investee's profit that belongs to the investor. The portion of the investee's loss that belongs to the investor is recorded as loss on investment. Next would be letter C. Distributions or dividends received from an equity investee reduce the carrying amount of the investment. Dividends received from an equity investee are not recognized as dividend income but as a return of investment. Next, letter D. Investment must be in ordinary shares. If the investment is in preference shares, the equity method is not appropriate regardless of the percentage, because the preference Share is a non-voting equity. Letter E. If the investor has significant influence over the investee is said to be an associate. It is appropriate to refer to the investment in ordinary shares as an associate investment under the equity method. Letter F. The investment in associate accounted for using the equity method shall be classified as non-current asset, given that the method covers the investment, which is a long-term asset, since they cannot easily be converted into cash within a year. So that's it for the accounting procedures.
So now let's dive into our discussion on application of equity method. So what are the things that we need to consider for us to apply equity method? So first we have significant influence. So what is significant influence? So this is already been discussed by my co-lecturer earlier. It is when an investor holds between 20% up until 50% of the voting power in an investee. It is generally presumed to have significant influence. However, significant influence can exist even with a lower percentage if other factors are present. Indicators of significant influence include the representation on board of directors, participation in policy-making processes, material transactions, and etc. When these indicators are present, the investor uses the equity method to account for its investments, reflecting its share of the investor's profits and losses in its own financial statements. The other one is goodwill. So, in the context of the equity method, goodwill arises when the cost of the investment exceeds the investor's share of the net fair value of the investee's identifiable assets and liabilities at the acquisition date. This goodwill is embedded in the CA of the investment rather than being separately recognized. Say, for example, if Company A purchases a 30% stake in Company B for 1 million pesos, and the net fair value of Company B's identifiable assets and liabilities attributable to Company A is 900,000. The excess of 100,000 is considered goodwill. So the accounting says this goodwill is not separately recorded but is included in the carrying amount of the investment and subject to impairment testing. Speaking of impairment, under the equity method, the investor must assess whether there's any indication that the investment may be impaired. The investor periodically reviews the CA of the investment for indications of impairment, such as significant financial difficulties of the investee, loss of significant influence, or adverse changes in the market environment. So we will recognize if there is a objective evidence of impairment. The investor calculates the amount of impairment as the difference between the CA of the investment and its recoverable amount. The impairment loss is recognized in the income statement. So, say for example, if the CA of investment in Company B is 1 million pesos and the recoverable amount is determined to be 900,000, an impairment loss of 100,000 would be recognized since the CA exceeds your recoverable amount. So that is the indication of the impairment. So in summary, the equity method means provides a means for investors to account for their investments in entities over which they have significant influence by incorporating elements such as those recognition of goodwill and regular impairment testing. The equity method ensures that the carrying amount of the investment reflects the investor share of the investee's net assets and its fair value, aligning with the economic reality of the investor and investee relationship. So we are done with the application of equity method. So let's proceed to the next slide. So when does equity method not applicable? I believe there are many following circumstances. Uh, the thing that I have noted there in the slide. First is lack of significant influence, which means ownership interest is below 20%. Typically, if an investor holds less than 20%, the voting power of an investee, it is presumed that the investor does not have significant influence over the investor's operating and financial policies. In this case, the equity method is not applied. Instead, the investment is accounted for at fair value, with changes in fair value recognized either through profit and loss or your OCI, depending on the classification. Next, we have the inability to exercise significant influence. So, what is the reason behind this? Even if an investor owns 20% or more of the voting stock, the equity method is not applicable if there are barriers to exercising significant influence. Such barriers may include contractual agreements, regulatory restrictions, or other circumstances that prevent the investor from participating in the policy-making processes of the investee. Third, control or joint control. So if the investor has control of the investee, the investment is accounted for using consolidation rather than the equity method. If the investor has joint control, the investment might be accounted for using the equity method or proportionate consolidation, depending on the nature of the joint arrangement, joint operation, or joint venture. Fourth, we have the election of fair value option. In some jurisdictions, entities may have the option to account for investments at fair value even if they would otherwise qualify for equity method. This is an election made by entity and is subject to specific accounting standards such as those provided by PFRS 9. Fifth is insignificant or minimal ownership. So what does it mean? In certain industries, even with ownership stake might normally indicate significant influence, for example, 20% to 20 to 50%, the equity method may not be applicable due to industry specific regulations or practices. For instance, in some financial institutions, regulatory requirements may dictate a different accounting treatment for certain investments. So take note of those circumstances under which the equity method does not apply. Now we will move on to the presentation of our problem where we will apply these concepts.
So now let's go to our problem. Make Hawaiian Incorporated acquired 50,000 ordinary shares of AAA Incorporated for 5 pesos per share and 125,000 ordinary shares of BBB Corporation for 10 pesos per share on January 2, 2020. Both AA Incorporated and BBB Corporation have 500,000 ordinary shares outstanding. Make Hawaiian clarifies investments in ordinary shares as FA at FVTOCI if equity method is not required. Changes in retained earnings for AA and BBB for 2020 and 2021 are as follows.
For the questions, based on the given information and the result of your audit, determine the following. Number 1. Income from investment in AAA Incorporated to be recognized in 2021 profit or loss. A. Nil. B. 1,000 pesos. C. 12,500 pesos. And D. 15,000 pesos. Number 2. Income from investment in BBB Corporation to be recognized in 2020 profit or loss. A. Nil. B. 2,500. C. 31,250. And D. 81,250. Number 3. Carrying amount of investment in AAA Incorporated as December 31, 2021. A. 250,000. B. 252,500. C. 325,000. And D. 350,000. Number 4. Carrying amount of investment in BBB Corporation as December 31, 2021. A. 1,250,000. B. 1,268,750. C. 1,350,000. And D. 1,875,000. And lastly, number 5. Accumulated OCI to be reported as separate component of equity at December 31, 2021. A. Nil. B. 25,000 loss. C. 25,000 gain. And D. 75,000 gain.
Start answering with the question. It is in determining the income from investment in AAA Incorporated for the year 2021 in profit or loss, aforementioned it being an equity investment owning only 10% of share. Therefore, according to measurement rules that I have introduced to you a while ago, that as a rule, it is recognized at fair value, and also cost method will be used because of the absence of significant influence. Going on, being it under the cost method, thus cash dividends earned are considered income. Now, to answer the question, it is stated that the cash dividends earned by AAA Incorporated in 2021 is 150,000 pesos, keeping in mind that Maykawayan Incorporated owns 10% of its share. Therefore, it takes part proportionate to that amount by, as we can see, by multiplying the percentage of 10% to the dividends of 150 pesos, 150,000 pesos. Therefore, we get the amount of 15,000 pesos. So, the answer would be letter D. For the second problem, we are now to get the investment income of Maykawayan Incorporated and BBB Corporation compared to the previous problem. This time, the stated company acquired 25% ownership, consequently having significant influence, which means equity method is used. To give you a refresher to what I have discussed a while ago, as the concept says, equity method is used when an investor controls 20 to 50% of the voting shares and has significant influence but does not have complete control over the investee. To answer the problem, according to the equity method, investor is basing their investment value on changes in the value of that company's net assets. It is stated in the problem that it owns 25% share and there is a profit of 325,000 pesos for the year 2020. As we can see, therefore we multiplied 325,000 pesos to 25%, getting a total of 81,250 pesos as the income for investment in BBB Corporation in year 2020. So, the answer would be letter D, 81,250 pesos. For the related standards, the two previous questions are related with the standard of PFRS 9 or Philippine Financial Reporting Standard 9, Financial Instruments, which goes over with the governing of the recognition and measurement of financial instruments that would be further discussed later on. And that's it for problem 1 and 2.
As discussed a few minutes ago, Maykawayan Incorporated does not have any significant influence over AAA Incorporated since the company only has 10% ownership. Thus, this makes Maykawayan's investment an equity investment. And according to the company's classification policy, this investment could be classified as FVTOCI or fair value through other comprehensive income if the company has chosen to designate it as such. Therefore, This falls under PFRS 9 financial assets. PFRS 9 financial instruments. This standard provides guidelines for the classification, measurement, and recognition of financial instruments. Under PFRS 9, if an equity investment is not held for trading, a company may irrevocably choose to classify it as FVTOCI at the time of initial recognition. These financial assets are initially recognized at fair value plus transaction costs that are directly attributable to the acquisition of the asset. After the initial recognition, investments classified as FVTOCI are measured at fair value. Unrealized gains and losses arising from changes in fair value are recognized in other comprehensive income or OCI and not affecting profit or loss. On the date of purchase, the value per share for AAA Incorporated is 5 peso per share, which cost Make Hawaiian a total of 250,000 pesos for its initial investment. However, there was a change in the share's value on December 31, 2021, and the current value of AAA's ordinary shares is 6.50 pesos. So in order to get the carrying amount for December 31, 2021, we need to multiply the shares acquired from AAA Incorporated to the fair value per share on December 31, 2021. This means that 50,000 shares are multiplied by 6.50 pesos, which results to 325,000 pesos.
Now, for question number 4. What is the carrying amount of investment in BBB Corporation as of December 31, 2021? To get the carrying amount of investment in BBB Corporation as December 31, 2021, we must first solve the carrying amount as of December 2020, since it was the year Make Hawaiian Incorporated acquired it. The investment will be initially recognized at cost since the ownership interest is 25%, thus accounted for using the equity method. To get the ownership interest, we divide the number of shares acquired by the outstanding shares, which is 125,000 ordinary shares divided by 500,000 ordinary shares outstanding. The carrying amount will be determined using this T account. This T account will help you solve faster, especially during exams, so this will be useful. The acquisition cost of BBB Corporation in 2020 is 1,250,000. We got that by multiplying the number of shares of BBB stock by the price per share, which is 125,000 shares by multiplied by 10 pesos price. Then, BBB has 325,000 income, so multiplying it by 25%, the investor will have 81,250 as a share in net income. BBB doesn't have cash dividends for the year 2020, so that will be 0. Thus, the carrying amount as of December 31, 2020 is 1,331,250, which will also serve as our acquisition cost for the year 2021. The share in net income will be 31,250. How did we get that? Yes, by multiplying 125,000 income by 25%. BBB had cash dividends for the year amounting to 50,000, which will be recorded as, yes, very good, as 12,500. We multiplied 50,000 by 25%. So the carrying amount as of December 31, 2021 is 1,350,000, which is letter C. Under the equity method, the effect of profit or loss on an investment in associate increases if there's a profit and decreases if there's a loss. This is because Make Hawaiian Incorporated, which is the investor, participates in the management of BBB. So the investor has an interest in associates' performance. For the dividends, it decreases because under the equity method, they are not income, but rather it is treated as a reduction to the carrying amount of the investment. That is also why that the cash dividend was in the credit side of our T account earlier. Note also that if there's a stock dividend, it is only recorded through memo entry as it is not accounted for because it does not result in changes in the total equity of the associate. Under the equity method, only those transactions that can cause changes in the total equity of the associate are accounted for in BBB Corporation as of December 31, 2021. And these will be our journal entries if it's being asked.
So we are now in question number 5. So what is question number 5? The question asks, what is the accumulated OCI to be reported as separate component of equity at December 31, 2021? So in determining the amount to recognize in accumulated OCI for Mikowayan Incorporated investments, it is crucial to recognize that the equity method does not involve recognizing unrealized gains and losses in OCI. Instead, under equity method, the investor recognizes its share of the investee's net income and dividends received, directly impacting the CA of the investment. In this case, Mikawayan Incorporated only acquired a 10% interest in AAA Incorporated, indicating no significant influence, and therefore the equity method does not apply. Mikowayan Incorporated classifies its investments in ordinary shares at, as financial asset at FBOCI when the equity method is not required. So let's proceed with the calculation for the year ending December 31, 2021, focusing solely on Mikowayan Incorporation's investment in AAA Incorporated. So the first one is the identification of relevant information. So here, as you can see here in the screen, the acquisition details is being given. So Mikowayan Incorporated acquired 50,000 ordinary shares of AAA Incorporated for 5 pesos per share on January 2, 2020. And also here are the fair values per share at year end for 2020 and 2021. 7 pesos per share and 6.50 per share respectively. Next is the calculation of the fair value of investments. So in order to get the fair value uh, as being asked in the problem, December 31, 2021, let us use the fair value per share at year end, December 31, 2021, 6.50 per share. So that cost per share is being multiplied by the acquired shares of 50,000 and the products is 325,000. Next is the calculation of initial investment cost or your historical cost. So the cost per share is being given in the problem already. The acquired shares is being multiplied by 5 pesos per share. The cost per share on acquisition, January 2, 2020, 5 pesos. The product is 250,000. So the difference of them is your unrealized gain or unrealized loss. Take note, if fair value exceeds your historical cost or the current market value exceeds your historical cost, then there's an implication of unrealized gain. If the other way around, then unrealized loss. So in this case, unrealized gain is being recognized, which is the difference between 325,000 and 250,000. Then we have 75,000 pesos at year end 31 2021 realized gain. So I have also prepared an alternative solution for this. So we determine the amount to recognize in accumulated OCI for Mikawayan Incorporated investments. We first need to identify the relevant information. Mikawayan Incorporated acquired 50,000 ordinary shares, as mentioned, for 5 pesos per share as of January 2, 2020. For December 31, 2021, the fair value per share is 6.50, resulting in a fair value of 325,000 for the entire investment. The initial investment cost was 250,000 or your historical cost, leading to an unrealized gain of 75,000 pesos for 2021. To assess the impact on OCI, we also need to consider the market value at the end of the preceding year, December 31, 2020, which was 7 pesos per share or 350,000 in total. The unrealized gain for 2020 was 100,000 pesos, which is presented as a component of OCI in 2020 comprehensive income. How to get the 100,000 pesos? You just simply deduct the uh, your market value in December 31, 2020 and your acquisition cost 250,000, and the difference of them is your unrealized loss, since uh, gain pala rather, unrealized gain because the current market value exceeds your historical cost. So next, comparing them, the market values between 2020 and 2021 results in an unrealized loss of 25,000 for 2021, as the market value in 2020 exceeded that of 2021. So the 25,000 realized loss shall also be presented in 2021 comprehensive income by adding the unrealized gain of 100,000 pesos and the unrealized loss in 2021, 25,000, we obtain a cumulative unrealized gain of 75,000, which shall be reported in 2021 in changes in equity. Therefore, the amount to be recognized in accumulated OCI as of December 31, 2021 is a cumulative gain of 75,000. So this approach simplifies the calculation by directly comparing the fair value at the end of the year with the historical cost, providing a straightforward method for determining the unrealized gain or loss for the year as required for reporting accumulated OCI. And here are your journal entries. So that would be the end of it. Thank you for listening and God bless.
And that's all for our today's lesson. We hope that you've learned something about investment and associate. See you in our next lesson. Bye!